African Reserve Bank is expected to announce its decision on the repo rate today, with inflation sitting comfortably within the target range at 2.7, 2.8%, and that's the lowest in over a year. There's growing debate about whether it's time to ease borrowing costs to spur economic activity. But others argue that holding the rate steady might be the safer option, given global economic headwinds, rand volatility, and ongoing domestic structural issues. Well, to help us unpack all of these issues and what we can expect, we are now joined by Frank Blackmore, who's the Chief Economist at KPMG South Africa. Frank, thanks very much indeed for joining us. Welcome to the program.
Good morning. Welcome.
So, Frank, the inflation rate has come down quite a bit. Given that, what do you reckon is going to happen later today?
Well, I think your introduction summarized it pretty well. Inflation is benign. In fact, it's below the bottom end of the 3 to 6% target range, and well below the center of that target range, that 4.5% we often hear these days. And that would give us an indication that if the bank wanted to reduce rates by an additional 25 basis points, it could comfortably do so. But the other part of the story came in your introduction as well, which is also true, is that the Reserve Bank sets policy now for the foreseeable future, so the next 12, 18 months. So it has to decide over that period, are there things that may influence the inflation rate and therefore the interest rate over this period. So although current inflation is very low and says, sure, we should have a cut, there are upside risks, as you said, the geopolitics. Will the US put trade tariffs on us? We might get sanctioned. The rand might lose some value. And all of that needs to be taken into account when setting interest rates, which just might mean that we continue to pause on those interest rate changes for the next, at least until the next meeting, when more clarity may be available.
If you were sitting in the MPC as one of the deciders, which way would you go and why?
Well, I'm biased because I'm a consumer as well and take part in this economy, and obviously a cut in rates would be beneficial to me and also other borrowers out there. It would mean I have a little more money in my pocket that I can then spend on other goods and services instead of repaying debts with that money. And it would also help to provide a boost, therefore, to the economy in terms of getting that growth a little higher than what we're seeing now. So I'd be inclined to cut. 25 basis points isn't going to impact one way or the other in a too large degree. So I'd be biased for a cut, given all indicators thus far.
So what's your biggest fear or risk, do you think, externally? You know, when we think about things like interest rates in the US or China's slowdown, what's your biggest worry?
The biggest worry would be just the geopolitical sort of trade tensions that are going on, what the impact on South Africa would specifically be. We know the president's recently been to the US. How did that turn out? I think there's just, the problem is uncertainty. If we knew that that meeting went well, and the sort of future for the relations between South Africa and the United States in particular, but rest of the world as well, were going to be as expected, then I would definitely go for that reduction in rates. But if that turns out to be, somewhat more complex than what I've described, then South Africa could be, we could feel the impact through mainly the exchange rate, and that would translate to inflationary pressures back in the economy, in which case leaving rates unchanged would probably be the prudent thing, at least for until the next meeting in July.
So if we look at the current inflation rate, some people might say the Reserve Bank is winning with its monetary policy, but I wonder, structural issues like South Africa's load shedding and a weak business confidence, fiscal constraints, do all of these limit the effectiveness of monetary policy?
I don't think the effectiveness of I think there's often this, where is growth in the economy created? Well, monetary policy sets an environment that's conducive to growth, and that environment should include low and stable inflation. Because if I'm a business and I want to invest for the next year, 3 years, 5 years, 10 years, a low and stable inflation rate, I can always calculate that in my business dealings. I have to borrow at one rate, I've got to repay at another rate, and I've got to make a return on that investment. And in order for that to all make sense in my business plans, I need that stable inflation rate environment. And I think that's what the monetary policy does rather well. The growth aspects, in terms of growth in the economy, that's more done in your fiscal policy with spending plans on things like your infrastructure and big public projects that allow the economy to grow at a higher rate over time. So monetary policy sets the scene, fiscal policy is more conducive to creating that growth environment. And I think, as you've said, monetary policy is done pretty well, but in an environment where we expected perhaps more growth to start taking place, given the fact that global inflation has reduced over the last year and a bit, to the levels that we're currently seeing now. But of course then these geopolitical events have started taking place, new administration in the US, and there's been a lot of uncertainty over trade globally, and that's kind of put a halt to this growth initiative that we would have thought would have come through given the lower rates and reduction in interest rates that we've seen over the last, let's say, year.
So we've run out of time, but very briefly, often the decision is one thing, but most people who are in the game listen to what is said supporting that decision and the tone. What will you be listening out for?
So first of all, obviously the decision will be important here. I think there are enough factors, as I've said, to allow a 25 basis point reduction, with a further view to perhaps another 25% reduction before the end of the year. And in order to know whether that's going to happen, I need to listen to what the MPC has got in their record regarding the risks, how they see the economy developing, how they see inflation, how they see growth, because all of those hold clues to what might happen in future. Another important thing is just to also see the votes. Is it a unanimous decision? Is it a split decision? And that often gives you the idea on how the panel is thinking about future reductions. So I'll be listening out for that in the speech.
Frank, it's been great talking to you. Thank you so much indeed for that great analysis. Thanks for your time.
Pleasure.
That's Frank Blackmore, the chief economist at KPMG, South Africa, and hinting towards a 0.25 percentage point drop in the interest rate. Let's keep our fingers crossed. It's time for your news headlines. Here's Joanne.